Welcome to a new episode of Policy Implications podcast, where policy meets research. I'm your host, Olga Zadorozhna from Kozminski University, where I teach under research in empirical economics. My guest today is Dimitrios Tsomocos, who is a professor of financial economics at Said Business School and a fellow in management at the University of Oxford. Dimitri's main areas of expertise include banking and regulation, systemic risk, and financial instability. And his research has had a significant impact on economic policy around the world, as he co-developed the Goodhart-Tsomocos model of financial fragility and has worked with central banks in countries such as England, Bulgaria, Colombia, Greece, Korea, and Norway. Today, we will be discussing the financial stability of European banking system and whether it is ready for the next big crisis. So, welcome, Dimitri, and thank you for agreeing to share your thoughts with us. So, you have done a lot of research on financial stability. What do you think about the current pandemics and what threats it brings to the European financial system?
Thank you very much, Olga, for inviting me to your podcast. I'm grateful for the invitation, and I'll try to give you, my view on the crisis just by starting with an old proverb that was given by a famous professor, Rutger Dornbusch, in 1997, in the aftermath of the Mexican crisis, whereby he claimed that the crisis takes much longer time coming than you think, and then it happens much faster than you have thought. Therefore, it is very important to react with resolution, with formidable determination, quite fast and efficiently. This current crisis, basically, as we first saw, is a crisis that affects both the demand as well as the supply side of the economy. And therefore, policy should deal with the pandemic and the health repercussions of the pandemic, the ICU units, and so on and so forth, the compensation of the various negative and adverse economic repercussions of the pandemic. Then we should try to boost effective demand, and more importantly, the new element that this pandemic brought corporate debt. The corporate debt has increased substantially as compared to what was happening in the global financial crisis, whereby we had an increase of the debt to GDP ratio. Here we have the corporate debt that slowly but surely will permeate the balance sheets of commercial banks and then credit extension, and that eventually will come back to haunt the real sector of the economy. Hence, for starters, I need to mention that the monetary policy, through almost everything they had at the crisis, and that applies and to the Federal Reserve Bank in the United States and the ECB of the European Union, the Eurozone, and the Bank of England and the Bank of Japan. However, as John Maynard Keynes said, you cannot push a string anymore because we may be in danger of creating a liquidity trap. Hence, we have now the two other tools, the regulatory policy that's available, and in fact, the supervisory and regulatory response has been quite substantial and to some extent has been quite effective. They will use various micro and macroprudential capital buffers that in sum were around 140 billion euros. Partially we have used instruments that do not qualify as tier 1 capital and common equity tier, and we are allowed the banks to operate below the liquidity coverage ratio. However, we have always to bear in mind that in the United Kingdom, for example, after 1945, after the Second World War, all the way because of the debt situation till the 80s, it was in a state of secular stagnation. Hence, regulatory policy would assist with macroprudential and microprudential tools the monetary policy. But most importantly, now we have to throw into the playground fiscal policy. And that's basically the idea of what the European Commission has tried to introduce. And the important thing is for this new EU fund that has been discussed so much should be disbursed as fast as possible, particularly to close the gap that exists between the countries of the North and the South that is widening and may potentially endanger the very viability of the Eurozone, as well as the well-functioning and the political integration of the European Union in general.
So those instruments that are available to our policymakers that help mitigate the negative consequences of the crisis, are they effective? And will there be any differences between the instruments applied to the current crisis and the previous ones?
The main distinction between the former crisis and this crisis is that monetary policy has exhausted its potential. Hence, what comes to fore is now fiscal policy and regulatory policy. In particular, as I said, the non-financial corporate debt ratio has increased substantially, more so than the household debt ratio and the private sector ratio. We have, for example, within 4 months from December 2019 to March 2020, in the United States, we have an increase from 45.8% to 48.6%. In the euro area, we went from 60.8 to 62.5. And that in a 4 months period, on a quarterly basis, that's quite substantial. And the same applies for the United Kingdom. Hence, resolution policies and the treatment of the NPAs and NPLs become of critical importance nowadays.
And so what are those fiscal measures, those fiscal instruments that can be now applied?
They were mentioned by the European Union policy. It's the Economic Recovery Plan of Europe, where you have basically the SURE ESM pandemic crisis support, which is a guarantee fund for workers and business, and there are 540 billion in loans. Then we have the Next Generation EU, whereby it will basically sum up between 2021 and 2024, 500 billion in grants and 250 billion in loans, and that is a very important thing. And most importantly is the multi-annual financial framework, which will be in the vicinity well over 1 trillion. And that will be between 21 and 27. The caveat in these fiscal measures is that the disbursement has to be unconditional, fast, and efficient. I don't think that the European economies, particularly the European economies of the South, that have been hit so tremendously and formidably during the global financial crisis and the Eurozone debt crisis, I do not believe that politically and economically and sociologically can sustain more stringent conditionality than they have always already endured.
Right, right. And in your recent paper with Aneta Hryckiewicz and Talia Krieg, you study bank resolution mechanisms. So under current circumstances of current pandemic, should we expect that more and more banks will be in need of those mechanisms, like, for example, bank sales, or maybe the state buying out the bank, or, you know, doing some other forms of bailouts?
Well, as we argue in the recent work with Aneta and Natalia Krieg of the EBRD, we state something that is very well understood now, that the COVID-19 crisis, and despite the drastic policy response, has produced a multitude of companies that basically walking on a tightrope, and in effect they are in the twilight between the living and the dead. Hence, we have now to reconsider the already existing frameworks for bank resolution. And the bank bailout mechanism basically may be thought of as a dead tool due to the moral hazard incentives, as well as high budgetary costs that many countries and many economies are not willing to sustain. So, in our work, basically, we have to try to tread carefully along four dimensions. First, redirecting banks' NPAs to the private investors might be difficult given the uncertainty and the evolution of the pandemic that may precipitate to limited market liquidity and difficulties in asset valuation. The second pillar of our analysis is that the resolution of NPAs, especially when the losses are redirected to creditors and CEOs and so on and so forth, generate further moral hazard issues with respect to incentives to conduct effective resolution of distressed debt. Third, the amount of support offered by the creditors by redirecting the losses might not be sufficient as contrasted to a huge bailout plan as the one that was implemented during the last global financial crisis. Last but not least, it is very tricky to ascertain that the available new resolution mechanism will have a material impact on systemic contagious effects of debt restructuring. Hence, what we did after we collected a novel data set that consisting of 39 systemic banking crises during the last more than 20 years, from 1992 all the way to 2017, and then we implemented and we compare and contrasted various resolution mechanisms using the Goodhart-Tsomocos model of financial fragility to assess the efficiency and the effectiveness of the various resolution mechanisms. And our results were mixed in the sense that we could not argue that one size fits all. So depending on the context, depending on the severity of the crisis and the bank performance criteria that we want to employ, then there were advantages and disadvantages of each resolution mechanism. In particular, in the event of a severe financial crisis, the creation of a bad bank, which is basically our preferred resolution mechanism, needs to be accompanied with substantial recapitalization. Only then we notice an improvement in bank performance, as well as restoration of the health of the bank's ailing balance sheets. We argue that pure restructuring without recapitalization during a severe and adverse economic scenario cannot restore the bank's health. In other words, the financial performance, despite the bad bank restructuring mechanism, will lead to a weak financial performance. Nevertheless, if we have at an early stage of a crisis, then the mergers that basically replenish the lost equity of banks offers better financial performance. So basically, our argument basically is that there are trade-offs of the various resolution mechanism, because the lack of sufficient capital discourages banks for taking deep restructuring efforts and streamlining their operations, like declaring their actual losses and not rolling over debts, and therefore maintaining in life zombie companies in fear of negative market reactions. At the same time, the trade-off of a pure recapitalization without any restructure does not help either. However, the main if you will, message of our research, besides the associated trade-offs, is that there exists a negative impact, or if you will, that bailouts do not seem to address banks' idiosyncratic risk in any efficient and effective way. However, we have to emphasize, and that's the power of the Tsomocos model, because it's a general equilibrium model that sees the feedback mechanism and the systemic first and second order effects. We have always to be careful in assessing not only how the idiosyncratic and the bank-specific risk will be addressed with a particular resolution mechanism, but also whether a particular resolution mechanism contributes to the mitigation of the systemic risk. Because the interconnectedness of the banking sector makes this of utmost importance. And that's what basically distinguishes the banking sector than the real sector of the economy.
Right, right. And so here in Poland, we have quite a difficult situation in the banking sector, I think, because the central bank recently has decreased the interest rates quite significantly to historical minimum, in fact, which resulted in major revenue decrease of those commercial banks. And most of them are, or a lot of them are systemic. And taking into account the experience of the European banks that have been having negative interest rates for quite some time now, what Polish banks can learn from them in order to adjust to the current situation? Or maybe the policymakers can offer some instruments to overcome these difficult situations for the commercial banks.
Well, I have to admit, I'm not an expert on the Polish economy and the banking sector, but I can say in principle, that quantitative easing, the debate of the zero lower bound in the European Union, or actually on both sides of the Atlantic, is with respect to the impact on the bank profitability. However, I believe if the main issue, the NPLs and NPAs more generally, is addressed by restructuring, the lower interest rates, if you have ample liquidity and a well-functioning of financial intermediation, can, depending on the elasticity of credit extension, may compensate the loss of profits with the increased and the more efficient allocation of savings to investments via credit extension. Therefore, the key issue is liquidity, treatment of non-performing assets, and delegated monitoring exercise, not to direct credit to consumption investments, but rather to productive investments in order to aid the ailing economies to recover and take a benign trajectory of economic growth.
Right. And in current situation, when the number of coronavirus cases increases throughout Europe quite significantly, and new measures are introduced, more restrictive measures are introduced by the states, what should we expect in the nearest future in terms of the stability of the financial system? What are your short-run and long-term forecasts?
Well, I don't belong to this group of economists that are involved in forecasting and, if you will, in financial fortune telling. However, may I say the important thing is to use the three arms that are in the arsenal of the policymakers: fiscal policy, regulatory policy, not so much monetary policy, to be able to preempt and withstand the evolution of the pandemic. Evidently, most of the future depends on how the evolution of the pandemic will shape our lives. And if you will, the resolution of the pandemic is more of a health and a medical issue rather than an economic issue. So we all rest our hopes to the development of vaccines and more effective cures of the pandemic that may help us to restore the well-functioning of our economies.
So you are optimistic about the financial stability in Europe, right? In the near future.
In general, I'm optimistic both about the financial stability of Europe itself. I hate at this point in time to feed more pessimism, gloom and doom in our thinking. So
Right.
let us be hopeful.
Excellent. Thank you very much, Dimitri. It was a very interesting conversation. Thank you for being here and answering my questions.
Thank you very much, Olga. Thank you for inviting me.